Grace and Owen are both 32 years old, live in the same city, and share the same goal: buying an entry-level home priced between $260,000 and $300,000 within the next 5 years. They're both renting, paying $1,400 a month, and each can only save $390 per month. Grace puts all of that money into a high-yield savings account. Owen invests the same amount in a broad stock market index fund, believing that 5 years is long enough for his money to grow faster than any bank account could. But the decision that determines who is holding the keys to a home after 5 years and who is still renting has nothing to do with choosing a savings account or the stock market. It comes down to 4 small decisions that most people with modest incomes never think about. If you're trying to save for your first home, subscribe to the channel, because this video could help you avoid mistakes that delay that goal by years. Their household income is $62,000 a year, below the roughly $78,000 that Realtor.com estimates is needed to afford an entry-level home in the US this year. That gap is exactly what most people searching for ways to save for a home are trying to close. Their target home costs $260,000, which is close to the national median price for an entry-level home this year. Their down payment goal is 10%, or $26,000, the median down payment made by first-time homebuyers in the United States, according to the National Association of Realtors, not 20%, which many people still assume is required. Grace chooses a high-yield savings account earning 4.5% annually, about 10 times the national average of roughly 0.4% to 0.6% that most Americans earn in traditional bank savings accounts. That 4.5% is a current rate, not a permanent guarantee. It may rise or fall as interest rates change, but its fluctuations are far smaller than what Owen is about to experience. Owen chooses an S&P 500 index fund based on the number nearly everyone who studies finance knows by heart. The U.S. stock market has historically returned about 10% per year over the long run. For the first 2 years, everything feels exactly the way the numbers promised. Owen's account grows steadily, and some months it jumps sharply. At work, he's the one with stories to tell during lunch breaks: how much his portfolio gained today, what the market did this week. Grace has nothing to talk about. Her account grows like a clock, slow, steady, and completely unremarkable. Some evenings, Grace opens her banking app, sees her balance increase by a few dozen dollars, and wonders whether she's missing something that everyone else seems to understand. After 36 months, Grace's account is sitting at around $15,000, almost exactly where the original projection said it would be. Owen's account, helped by several strong quarters in a row, has climbed past $16,300. But the stock market doesn't rise smoothly every quarter and magically add up to 10% a year. It goes up one quarter, falls the next, then rises again. Owen has only experienced the good half of that journey so far. Feeling like you're winning and actually winning are not the same thing. And this is where the real risk begins to accumulate before anyone notices it. The average 10% annual return is only meaningful when measured across many decades. Over any specific 5-year period, the result can be much higher, much lower, or even negative. No one knows in advance which 5-year period they're going to get. Month 57. Just 3 months remain before Owen and Grace reach the end of their 5-year plan. Owen's account has grown to $28,300, above his $26,000 down payment goal. He has already started touring homes and imagining his future living room. Then, the market falls. Not just a bad week. The U.S. stock market lost more than 30% of its value in just a few weeks in early 2020, and more than 20% over the course of 2022, twice in the last 6 years alone. This time, Owen's portfolio drops 20% in 6 weeks. His $28,300 becomes $22,100. Every night he opens the app, watches the red numbers grow larger, and realizes there is nothing he can do except wait for the market to recover. He needs $26,000 for the down payment. Now he has two equally painful choices: sell everything, lock in the loss, and still come up with nearly $4,000 from somewhere else, possibly by borrowing from family, using a credit card, or both, which means taking on new debt right after buying a home. Or postpone the purchase, wait for the market to recover, and hope the house he wanted and the mortgage rate he was offered are still there when he comes back. At the exact same time, Grace has $24,700 in her account. 3 months later, right on schedule, she reaches $26,000. No loss alerts interrupt her sleep. She signs the purchase agreement on the date she planned. That's where the story ends, in year 5, because this is the real question for anyone saving for a home. Not who becomes wealthier, but who has the keys when they actually need them. That doesn't mean Owen chose the wrong investment. If he hadn't been locked in to buying in exactly year 5, if he had been willing to wait another year or two for the market to recover, most of that paper loss likely would have come back and perhaps grown beyond what Grace ever accumulated. Owen's problem was never that he chose stocks. His problem was that he left all of his money in stocks until the exact moment he could no longer afford a loss. In reality, Grace and Owen made the same mistake, even though they ended up with different outcomes. Both kept 100% of their money at one extreme for the entire 5 years, without adjusting for how much time remained. Grace was completely safe, but she gave up much of the growth she could have captured during the first 2 years. Owen captured strong growth, but he carried full market risk right up to the moment he needed the money most. So the real question isn't whether you should use a savings account or invest in stocks. The real question is whether you already have a plan for what happens when the market doesn't cooperate, or whether you're simply hoping it won't happen right when you need the money most. This is where the story stops being about who was right and who was wrong, and becomes useful for anyone trying to save for a home right now. 4 specific adjustments you can make immediately, even if your household income is only $62,000 a year, just like Grace and Owen. The first adjustment? Shift gradually, not all at once. If Owen had started moving money from stocks into a high-yield savings account when he was 24 months away from his deadline, for example, transferring about 10% of his portfolio into cash each quarter, then by month 57, most of his down payment would already have been sitting safely in a high-yield savings account. A 20% market drop would have affected only the small portion still invested in stocks, not his entire down payment. The rule is simple. The closer you get to the day you need the money, the larger your cash allocation should become, regardless of whether the market is rising or falling. This isn't about retreating out of fear. It's a rule you follow on a schedule, decided today, rather than a decision made in panic after the market has already fallen. The second adjustment? Automate your savings the moment your paycheck arrives, before you spend anything. This isn't some minor psychological trick. The money people save most successfully is usually the money that leaves their spending account before they even notice it in their balance. Set up an automatic transfer of $390 on every payday into a separate savings account that is completely isolated from your everyday spending account. Don't wait until the end of the month and move whatever is left over, because for most people, whatever is left over tends to be zero. At $390 a month, missing even 1 or 2 months because you spent first and planned to save later can push a 5-year goal into 5.5 years, or even longer. An automatic system doesn't require you to have more willpower than you had last month. It only requires you to set it up once. The third adjustment? Check for down payment assistance programs before trying to save the entire amount on your own. There are more than 2,000 down payment assistance programs across the United States, offered by states, cities, and nonprofit organizations. Most are designed specifically for first-time homebuyers with incomes similar to Grace and Owen's, not high-income households. Some provide interest-free loans, some offer grants that never have to be repaid, and some simply require the buyer to complete a short homebuyer or personal finance course before receiving assistance. Many people qualify and never even check because they assume these programs aren't meant for them, or they think the application process is more complicated than it really is. Before spending 5 years trying to save $26,000, one evening researching down payment assistance programs in your state could shorten that timeline dramatically, sometimes by half or even more. Some programs define a first-time homebuyer as someone who has not owned a home in the past 3 years, not necessarily someone who has never owned a home in their entire life. A surprising number of people rule themselves out simply because they misunderstand that one requirement. The fourth adjustment, and this is where today's down payment determines your monthly payment for the next 30 years. For a $260,000 home with a current 30-year mortgage rate of 6.7%, a 10% down payment means putting down $26,000 and borrowing $234,000. The monthly principal and interest payment would be about $1,510, plus roughly $146 per month in private mortgage insurance, or PMI, because the down payment is under 20%. That brings the total to about $1,656 per month. With a 20% down payment, or $52,000, the loan amount drops to $208,000. Principal and interest fall to about $1,343 per month, and there is no PMI at all. The total monthly payment is about $1,343 per month. That's a difference of more than $300 every month for decades, simply because of an extra $26,000 up front. Even if you can't reach a full 20% down payment, every additional percentage point reduces your PMI. And with a conventional mortgage, PMI usually disappears automatically once the loan balance falls below 80% of the home's value. In other words, a larger down payment today not only lowers your payment immediately, but can also eliminate that extra insurance cost sooner in the future. This is exactly where an FHA loan, which allows down payments as low as 3.5%, becomes a real trade-off rather than a free shortcut. It could allow Owen or Grace to buy a home much sooner, perhaps after only 2 years instead of 5. But it also means a larger loan, higher mortgage insurance costs, and heavier monthly payments for years afterward. In some FHA loans, that insurance can last for the life of the loan rather than disappearing automatically the way PMI often does with a conventional mortgage. Buy sooner or pay less each month later. There isn't one right answer for everyone. There is only the answer that fits your income, your timeline, and your tolerance for risk. Any unexpected money goes directly into the down payment fund, not into spending. The average U.S. household tax refund is around $3,000 a year. A year-end bonus, overtime pay, or a small raise after a performance review often disappears into little lifestyle upgrades that no one can remember 6 months later. If Grace or Owen put a $3,000 tax refund directly into their down payment account each year for 5 years, that would add up to $15,000, more than half of their $26,000 goal, without changing their $390 monthly savings at all. No lifestyle upgrade, just a one-time redirect of money that was never part of the monthly budget in the first place, which means most people won't even feel the difference. And don't treat a 4.5% high-yield savings account as a fixed number and forget about it for 5 years. The best savings rates on the market change as overall interest rates change, and an account that was leading the market today could be lagging behind a few months from now. Checking your rate every 6 months and comparing it with a few online banks takes less than 10 minutes. But over 5 years, on a $26,000 balance, Even a half percentage point difference can add up to several $100s that you don't have to earn any other way. If Owen had made the first adjustment, gradually moving money into cash starting in month 36, instead of leaving 100% of it in stocks until month 57, his balance at the bottom of the downturn would not have been $22,100. Most of his down payment would already have been protected before the market fell, and he still could have signed his purchase agreement on schedule, just like Grace. Grace didn't need that adjustment because she never put all of her money at one extreme in the first place. But she also never captured the growth the stock market offered during the first 2 years, when the risk was relatively low because she still had plenty of time. That is the real thread connecting all 4 adjustments. None of them requires earning more than $62,000 a year. They are simply ways of organizing the money you already have so that it is in the right place when you need it. None of these 4 adjustments appears on a bank billboard. They don't sell a financial product, and no one collects a fee when you follow them. That may be exactly why they are talked about far less than the question everyone keeps asking. Should you save in a bank account or invest in the stock market? This is a financial scenario, not personalized financial advice. Taxes, risk tolerance, and down payment assistance programs vary from state to state and from person to person, and they can change the right answer. But there is one variable that matters even more than how fast you save, and we haven't covered it in this video: the mortgage rate you actually end up paying, and how to negotiate it lower than the first rate a lender offers you.